Welcome. Hello. Welcome to the Strategy for a First-Time Homebuyer. This series is your ultimate guidebook through the exciting journey of purchasing your first home. From the essentials of building your credit to navigating the intricacies of mortgages and beyond, we've meticulously crafted each step to ensure you're fully equipped for this significant milestone. So, let's get right into it. I just wanted to kind of give you a quick overview of the modules that we will be going over if you stick with us. The first module, Module 1, is what I'm going to be going over today. So keep an eye out for the other modules in other sessions or in emails, but you'll see them. So Module 1, Mortgages 101. Deep dive into mortgages. We're going to explore various mortgage types, rate options, amortization periods, and just empowering you with more knowledge so that you can choose the right mortgage for your needs. So if you don't understand any of the words I just said, that is totally fine because we're going to go into it a little bit more in Module 1 when we get there. Module 2, we're going to unravel the complexities of credit. Understanding and managing your credit score is fundamental as it significantly impacts your mortgage options and terms. Numbers 2, 3, and 4, or modules 2, 3, and 4, we will be going in, or will be, clumped together in the next session. And modules 5, 6, and 7 will be in another session as well. So module 3, focus on income, what you can expect to need to provide when applying for a mortgage. Module 4, we're going to go over everything that you need to know about down payments, the minimum amounts required, the allowable sources. And then in Module 5, we'll explore a little bit more about the various programs and incentives that are available to assist you in saving for your down payment and the purchase of your home. Module 6, we got closing costs. So this is the costs of purchasing a home that are in addition to your down payment. And we're going to talk a little bit more about what to expect for those closing costs. And finally, for Module 7, bringing it all together, we're going to guide you through the final stages of the home buying process, from making an offer to the closing day when you actually will receive the keys to your new home. So join us as we go on this journey to provide you with the tools, knowledge, and confidence to navigate the path to home ownership. So let's dive in. We got Module 1. So Module 1, we're going to be focusing exclusively on learning all the different aspects of a mortgage. So before getting into the technical aspects of mortgages, let's really initially explore the options available for obtaining a mortgage. Now, in Canada, we got 2 ways that you can arrange a mortgage: through your bank branch or through a mortgage agent or broker, aka me. So at your branch, you're limited to the bank's products and rates that are offered by their sales rep. With a mortgage agent, you have access to products from many different lenders, offering you quite a bit more options. So I wanted to just highlight some key points about mortgage brokers and agents in case you don't know what we're about. So we are free to use in nearly all cases, except the only times when it's not free is if you're arranging lending with a non-prime lender. And if you're working with us, we will let you know way up front if you're going to be in that non-prime lending space, so you'll be aware. We have access to over 30 plus lenders, including the major banks, credit unions, mortgage companies, and I would say almost most importantly, is we act on your behalf. Our whole goal is prioritizing your best interests. Coupled with our unparalleled product knowledge, empowers you to hopefully make more informed choices, and ensuring that you'll select the best rate type and product aligned with your actual goals and needs. So as well, our access to multiple lenders ensures you're getting the most competitive rates. This flexibility sets us apart from branches, which only have access to their own rates. And of course, industry knowledge. We stay informed through regular meetings on economic trends, policy changes, which we then will use to help us assist in choosing the appropriate rate type and term based on the current economic conditions. These are our lenders. They can be categorized into major banks, credit unions, mortgage companies, alternative lenders, and finally, private lenders. So we'll assist you in selecting the lender that's based on your own personal preference, whether it's rates or available products, maybe your income type, credit profile, or any other unique mortgage requirements. Our role here is to thoroughly understand your financial goals, upcoming life events, and economic conditions, guiding you to make the most suitable decision. So, let's talk about the two main mortgage rate types, fixed and variable. So, with a fixed rate, your interest rate stays constant throughout the term of your loan, keeping monthly payments predictable and also making it easier to budget. Then we have the variable rate on the other side, which is a floating rate. The variable rate doesn't have a fixed rate. Instead, they have a rate that is tied to the Bank of Canada rate decisions. You may hear me say prime, and that's what we're talking about. The Bank of Canada schedules about 8 rate announcements yearly, and those rate announcements are what impact the floating rate. So in a slow economy, rates may drop to encourage lending. However, in times of high inflation, rates might rise to curb spending and bring inflation down. So variable rate mortgages can go even another level deeper, which we see as the red words here. So in a variable rate mortgage, you can either have a mortgage payment that is static or adjustable. If you have a static payment, your payment will stay the same even if the rate changes, but the amount that's applied to principal and interest will be adjusted within the payment amount. Meanwhile, with an adjustable rate mortgage, the mortgage payments fluctuate with the changes to the prime rate. So it keeps you on your amortization schedule. So your payment changes. When choosing a rate, it does boil down to a few key factors. We got the economic conditions, your financial goals, property use, and risk tolerance. So if you prefer stability in your payments, you may opt for a fixed rate, especially if you can't really afford payment fluctuations. And on the other side, if you're thinking of making changes during your term, or just there might be changes in your life, or you're just not sure, you might consider a variable rate because it has a lot more flexibility, or maybe a shorter term fixed rate. So economic conditions play a crucial role as well here. So it's really important and essential to work with someone knowledgeable about your economy's impact on rates. Ultimately, your choice depends on stability, future plans, property use, and current market dynamics. Once we determine, economic conditions, financial goals, property use, and risk tolerance. Once we determine your rate type, we move on to strategically choosing a mortgage term. Your mortgage term refers to the contract length and the duration for which a specific rate is locked in. So many people focus on rate as the primary way to save money on a mortgage. However, some of the most significant savings actually come from selecting the right term and amortization for your mortgage. So most lenders offer terms ranging anywhere from 6 months to 10 years. But how do you decide? Similar to picking a rate, the right term aligns with your long-term goals and economic conditions. And another factor in choosing your rate type and term is the stress test, which you do need to take in order to qualify for your rate. So, the financial assessment, called the stress test, is implemented by financial institutions. It assesses a borrower's ability to manage their mortgage payments if interest rates were to increase. So borrowers are stress tested against either the higher of the minimum qualifying rate of 5.25 or contract rate plus 2%, whichever is higher. So this really is just to ensure that borrowers can manage their payments if interest rates rise in the future. So once we establish your rate type, your term, the next step we look at is your amortization, which refers to the total amount of time to pay off your mortgage. So if you're putting less than 20% down, you're required to qualify on a 25-year amortization, which gives you insurable pricing, the lowest rates in our pricing tier. So less than 20%, lowest rates, 25-year amortization. However, if you have more than 20% down, you can go as high as a 30-year term. This option offers better month-to-month cash flow, which you can use prepayment privileges to pay down your mortgage faster while benefiting from lower monthly payments. So keep in mind that you do have to qualify for your amortization. So the shorter the length of time of your amortization, the higher the mortgage payment will be, which potentially means you might qualify for a lesser amount. We're going to talk about prepayment privileges very soon. So, lastly, the two terms that you should know about on your mortgage are prepayment privilege and prepayment penalty. Prepayment privilege refers to the amount you can pay on your mortgage before you face a penalty. So generally you have two options. You have a lump sum payment, so which allows you to put between 10 to 20% of your remaining balance per calendar year. So you can prepay that if you'd like. The other way you can do it is an increase to your mortgage payment, again, by 10 to 20%. And it enables you to just boost your mortgage payment, and it's not that lump sum once a year. The benefits to using prepayment privileges is that it allows you to pay off your mortgage more quickly. Even small additional payments can significantly reduce the total time needed to pay off the loan. These interest savings, so paying more towards your mortgage, means less interest paid over the entire life of your loan. Interest is calculated on the remaining balance. So by reducing your principal amount, it will decrease the overall interest that's accrued. And finally, we got prepayment penalties. Prepayment penalties occur when any payment beyond the allowed amount triggers a penalty. So this typically happens when you're breaking your mortgage before the maturity or renewal date. For variable or adjustable rates, penalties typically are calculated as a 3-month interest penalty. So this varies between the lenders on how or what rate they use to calculate it. So it might be your contract rate or the prime rate. On the other side, we got fixed rates. With fixed rates, the penalty is calculated as the greater of a 3-month interest penalty or the IRD, which is the interest rate differential. The IRD calculation involves comparing the discounted rate and the posted rates, and it calculates the difference in interest fees left to pay based on both those rates. Super confusing, really convoluted. It's one of the most confusing calculations to kind of do, and it's hard to calculate ahead of time. It really is. In the future, if you break your mortgage, that's something that we need to do. What I will tell you as an overall about prepayment penalties as a whole, variable rate and adjustable rate, more prepayment penalties are typically, most of the time, quite a lot lower than breaking a fixed rate mortgage. So IRD is typically significantly higher than 3 months interest penalty. So the key to avoiding high penalties lies in planning and choosing the right mortgage rate type, term, and product. So as you can see from all of this, mortgages involve much, much more than interest rates. Understanding your individual goals, income type, and risk tolerance are crucial in building the right mortgage for yourself. So we're going to guide you through all the available options and assist in choosing based on your unique needs. That's what we're here for. And up next, we're going to talk about credit and cover everything you need to know about credit That'll be in the next session, and we'll see you there. All right.